Is your individual retirement account an IOU to the IRS? If you are approaching retirement and your retirement funds are in an IRA and you would like to build your dream retirement lifestyle with investments that you have, then this will be the most important video you watch all year. Here's why. Millions of Americans aren't confident in their ability to retire. Will I have enough? Will it last me long enough? Can I take this vacation? Can I keep doing the things I love doing? In just a second, you'll discover the things you need to know. Build the life you've dreamed of, living during your retirement. Plus, in this video, you'll also discover how to get personal help and guidance to make achieving your goal of a successful life in retirement completely complimentary. Hi, my name is Carlos Bastardo, and I am an Army veteran with 30 years experience in the financial services industry and have been helping people just like you for over the past 30 years to build a successful retirement and live the life that they want to live so they don't have to give up the hobbies they enjoy, say no to the vacations with family, or be stressed that they have enough to keep them going. I'd love to help you too, but first, let's talk about the most important things you need to know to build the life you've dreamed of living during your retirement. We are in a unique time in our country's history. Never have taxes been this low. Moreover, the federal debt is over $32 trillion and continues to skyrocket. Who will the government seek to pay this debt? Can your IRA be an IOU for the IRS? Ask yourself this question. What tax reduction strategy has my financial advisor or tax preparer suggest that I have not implemented? Far too often, people seeking my help have told me their advisor has never offered tax reduction advice. And if you're looking to fund the lifestyle you want, the more you're paying in taxes, the less that is left for you to spend and enjoy. First off, do you know the rules of the game? What are the rules of your IRA? What tax laws apply? When must you take money without or face paying a huge penalty of as high as 50% on the amount required to withdraw? Why does the government require you to withdraw at a certain age? Required minimum distributions, otherwise known as RMDs. Why does the percentage you are required to withdraw increase as you age? And the IRS prohibits taking the after-tax money from an RMD and placing it into a tax-free Roth IRA. All of these factors serve to increase your debt to the IRS. September 2nd, 1974 was an important date. This was the date that IRAs were first born. Although the law was passed on that date, much thought was given to how these accounts would be taxed. You will see that laws were put into place to allow the government to cash in on your IRA savings. Note that IRAs impact each of us differently depending upon your net worth. Savers are penalized as well as high earners. For these reasons, lower to moderate income earners most likely will have a much more favorable outcome with their savings plan. In fact, for most Americans, IRAs are an efficient savings vehicle. Large IRA owners, 1 million plus, may find that they pay more in taxes over their lifetime and death, yes, death, than they withdraw. Savers are at a disadvantage on several fronts. They are the exception. Most press is directed to the non-saver whose focus is to somehow survive retirement. It gets down to this. You had a plan to save and it worked. If life is a football game, you are at halftime. How you play the second half will determine victory or loss. The saving portion of your plan is complete, but what about your exit strategy? This is where the rubber meets the road. What is needed at this time is not a better investment. You need knowledge. The knowledge to enable you to keep more of what is already yours. I'm going to provide a simple example of how your IRA is taxed. You will see how lack of knowledge leads to making irreconcilable mistakes. The purpose of this example is to demonstrate that this does not have to be you. The average person cannot do this on their own. You need the help of a professional with expertise in this area. Congress had a choice in establishing the way IRAs are taxed. Number one, lowest tax rate of 0. 2, a tax advantage, tax structured capital gain. And 3, the highest tax rate in the land ordinary tax rate. You guessed it, they chose the highest tax rate, the ordinary tax rate. They have another decision to make. How was your IRA to be taxed at death? Would it receive the same treatment as non-retirement savings, which is not taxed at death? Again, the answer is no. At death, IRA accounts are subject to an income in respect to decedent, income a person would have received had they not died, tax. When I look at how your IRA is structured, it almost seems that Congress studied how consumers spend their retirement savings. In fact, the General Accounting Office, known as the GAO, did just that. Now I ask myself, why would Congress want to know how we spend our retirement accounts? Here is what the GAO found. Retirees share a common fear. They are afraid of outliving their money. This affects how they spend it. Upon retirement, most of us watch every single penny. If we can live off of our Social Security and non-retirement account savings, we will. We won't touch our retirement accounts for two reasons. First, we are afraid of outliving our savings. Secondly, we don't want to pay extra taxes. Here is one of the most remarkable, startling things I have learned about IRAs. It seems Congress took the GAO report and structured IRAs so your natural aversion and behavior towards taxation leads you to unknowingly pay the highest tax rate. There are distribution rules. Yes, that's right. There are rules as to when you must take money out and be taxed at the highest ordinary rate. Consider what most people do. So far, you've discovered, upon retirement, we touch as little of our retirement savings as possible. We scrimp and we save to protect our savings and seemingly save on taxation. While we do this, our tax bill within our IRA is growing exponentially. Consider $1 million IRA has about $400,000 of tax that is owed to the IRS, deferred, but nonetheless owed. Compounded at 7.2%, your tax accrues as follows: 10 years, $800,000, 20 years, $1,600,000, 30 years, $3,200,000. If you do what your friends and neighbors do, you may be in the same position as they find themselves paying more than is necessary to the IRS. Your IRA is subject to 6 levels of taxation. Number 1, RMD, required minimum distribution. This is the amount of tax each year at your highest tax rate. Number 2, effective tax rate on all dollars is elevated by RMD. Number 3, RMD that is invested in savings is taxed again. Number 4, RMD contributes to tax on Social Security. Number 5, RMD contributes to cost of Medicare. And number 6, income in respect of a decedent IRD balance of IRA is subject to taxation at death. The biggest culprit to growing your tax liability is the RMD. This RMD begins at age 72. It is calculated by a divisor that increases the percentage of your RMD each year. The amount of your RMD is determined by your advisor and the increasing balance of your IRA. So, what do these RMDs look like? Consider a 58-year-old IRA holder with a $1 million account. Here are the RMD amounts at given ages: 72, 100,000, 724, 82, 183, 698, and age 90, $264,981. Imagine what this extra income does to the effective tax rate on your tax return. You are correct. It raises the taxes on every dollar on your return. If you use the IRS plan, you will pay the most possible tax. So what should you do? Something different. To put yourself in a position to keep the most money, you must take a disciplined scientific approach. You will find few people in this country that have the process to do this. This should be done mathematically. Do not approach this with assumptions. The math matters. What is needed for your savings is an exit strategy. Do this by creating a model to compare and contrast. While it takes time and expertise to reach an answer, the approach is straightforward. The solution is to move money from accounts that are taxed every day to ones that are taxed only once. The most effective tools are the Roth IRA, tax-free retirement income. This retirement account is different than a conventional IRA. You must pay tax when you open the Roth account, but once matured, never again. It is not subject to RMD, inherited by loved ones tax-free. There are qualification rules for contributions to Roth, of course, but there are no restrictions when converting a traditional IRA to a Roth IRA. Another strategy is overfunded life insurance. This is using life insurance for a different purpose than death benefit. This involves buying the least amount of insurance possible and investing additional money into the policy that goes to the tax-free living benefit. There is potential to receive significantly higher tax-free income from overfunded life insurance policies. Not all will be able to participate due to health underwriting component. Nonetheless, it is essential to explore every opportunity to keep what is yours. Let's take a look at a typical case from my office. Here we have a client age 58. Retirement age is 65. Desired income at age 65 is $114,869 a year and increases at 2% per year for inflation. Current assets of $1.7 million in an IRA and Social Security benefits of $68,921. My initial analysis reveals something very significant. This client was set to have an excess cash flow of $3,290,353 due to RMD requirements. This excess cash flow would be taxed at the client's highest ordinary rate. Excess cash flows raise the effective tax rate on all monies on the return. This is the clearest indicator that the account owner is in a position to lower the long-term tax paid with simple, straightforward planning. In this case, we illustrate converting, taking money out of the IRA, paying the tax due, and investing in a Roth IRA. So $200,000 per year for 5 years. This will generate a tax due each year of $60,000. The net after-tax savings to this client through age 90 will be $1,799,254. This is a savings, or in fact earnings, of $1,799,254 with zero risk. So far, you've discovered to build a successful retirement and live the life that you want to live without having to give up the parts of your life that you enjoy. But it's crucial you understand this one thing. You can build a successful retirement without giving up on the hobbies you enjoy, saying no to the vacations with family, or being stressed if you have enough to keep them going. Because you're watching this video, it shows you're serious about building a successful retirement plan. And I would like to personally help you create a strategic plan for helping you build a retirement plan fitted around exactly what you want to get out of your life. There's no obligation for this, and it will only take between 30 and 45 minutes. After doing this for years, I've gotten good at quickly getting to the crux of the matter. I will do most of the heavy lifting for you, showing you how to, all of the key considerations you need to make sure you're not blindsided during your retirement. At the end of this initial planning session, one of two things will happen. One, you love the plan and decide to try and implement it on your own. If that's the case, I'll wish you the best of luck and thank you for meeting with me. Second, you'll love the plan and ask to become a client so I can personally help you execute and benefit from it ASAP. It's really that simple, and there is no catch. Think about this. Please consider what can happen if you invest 45 to 60 minutes of your time and get some helpful information. The best that can happen is you'll work with me to build that retirement built around your goals. Here's how this works. First, we understand exactly what you want your lifestyle to look throughout your retirement. Then, we'll look at your finances, investment accounts, and other assets to see what we have to work with. And finally, we'll match your goals with your financial situation to help build a plan that suits you. By the time we're done talking, you'll have a roadmap on the exact retirement lifestyles you want and how you can use your current investments to fund this lifestyle. And remember, there is no obligation for this. So why would I offer this to you? Two reasons. First, I enjoy it. This is what I do best, and it makes me happy to see someone start to live the life that they deserve to live. Second, this is how I attract clients. Here's how that works. Assuming you're happy and you want me to implement this plan for you, I might invite you to become a client. If you decide not to become a client, that's fine too. You won't get any pressure or sales pitch ever. The truth is, this is not for everyone. I'm very selective about who I talk to, and I have a set of criteria that needs to be met in order to proceed. Here it is. First, you need to be lifestyle focused. The most important part for me is making sure that we are helping you with your lifestyle and not just money. Second, you need to be within a few years of retirement or already retired. Most of our planning strategies are most beneficial when you either are very close or in your retirement. Third, you need to have at least $250,000 of investable assets. We find we can add the most value to our clients when they have at least that amount. Fourth, you need to be willing to take advice and listen. If you think you know it all and no one can help you, then we won't be a great fit to work together. Here's what to do next. Assuming you meet the criteria and you would like to talk with me, I'll happily set aside time for you. The process for that is as follows. First, you'll be asked to complete a simple application. Don't worry, there aren't any hard questions. I want to get some information in advance so our time together is as productive as possible. After you complete the application, you'll be taken to my online calendar so you can select a time to talk. Again, your initial call or meeting with me will be between 45 and 50 minutes. This is where we'll start working together and figure out what your goals are and how to best achieve them. If at the end of your meeting you decide you want to become a client, and I agree it's a good idea, great. We'll discuss it. Again, if you decide you don't want to become a client, then that's fine as well. Please understand, time is of the essence. I've allocated a limited amount of time for these complementary strategy sessions. I spend most of my time working with clients to get them results. So if you feel like this is right for you, click the button below to get access to this application and then schedule time to speak with me. This is your opportunity to get advice from a true experienced professional with expertise about how you can build yourself a successful retirement based around your personal goals and aims without obligation. If this sounds good to you, click the button below to set up a time for us to chat. Meetings are accepted on first come, first served basis. Click the button below and get started now while it's fresh on your mind.